Peter McGuire, Chief Executive Officer with XM Australia, and we've got Dr. Kang Wu, Head of Global Demand and Asia Analytics with S&P Global Group. They both join us to understand that how exactly and where is crude headed. Is this more like a geopolitical risk which crude prices are pricing in? And what if we see a Russia invasion of Ukraine? What happens in that scenario? I mean, will that mark also as a peak or a top for the crude market? Peter, now we can get into yes, no, but a lot of fakes are saying, I don't know about why crude prices have gone higher. Bottom line is, crude prices have gone higher without any demand scenario. Do you think this kind of a risk premium is not going to last, or will it continue?
Well, I think there's a lot of reasons why crude's edged higher, and we're saying edged 40% nearly boom to the upside since mid-December. So over that 2-month period, it's a monstrous move, and here we are now just under 96 for Brent. We've got super backwardation, as we're conscious of. We've got supply underinvestment, which leaves the market vulnerable. So you've got to think of those global themes, plus the Omicron issue seems to be very much dissipating. So from a global demand picture, we've got increasing demand, we've got underinvestment, and we've got a shortfall across many different commodities, from base metals and certainly to the energy sector.
So Peter, what would you advise your clients? Ride the momentum, ride the good times, or it's time to have a reasonable view based on demand and supply. The difference between this geopolitical tension and the other geopolitical tensions are that America is a net exporter, and demand of crude, in a sense, soon will be replaced by EVs.
Well, I think that yes, and it certainly will be replaced, but I don't think it's going to be immediate, and I think it could be a slower take-up than what we anticipate. But the second part of the question is how much risk premium has been built into the price due to the Ukraine situation. So is it $3? Is it $5? Is it $10? And if we do see something materialize as far as any form of rhetoric and rises, and let's just hope there's no kinetic side to this as far as a war, then if that was to materialize, then you'd see crude probably gallop another $10 to $15, $20 a barrel. So I think most traders are realizing that it's been a very good 2 months, and be very conscious because it could whipsaw dramatically if there was to be some form of olive branch extended and peace to be the ultimate solution.
Dr. Kang Wu, wanted to get in your take as well. Given the fact that Russia is one of the largest crude oil producers, do you think that if we see some sort of a disruption in the flows from oil, that could send prices skyrocketing even over $100 a barrel? And how are you looking at agencies like the OPEC as well as the IEA really, coming in with respect to the kind of the output that they can do to manage the supply for the increased demand for crude?
Yeah, I think the current high prices are more driven by concerns over future supplies, not long-term future, maybe the future supply of this next few months and everything, over the purely supply-demand fundamentals. When I say purely demand-supply fundamentals, I meant to say that supply is there, in terms of the current level of supply. And the demand, of course, is persistent. The demand is not disrupted by Omicron. It stays there. But seasonally, the first quarter and currently is not a high season. The demand is a kind of a moderate. But the concern, but the inventory are super low, and that support high prices. And people's concern over the immediate supply for the next few months, lead them to the buying. As to your question, yes, the risk factors, as mentioned by Peter, they are pricing somewhat, but not fully. So yeah, Russia is a very important supplier. If the war breaks out, it's all depending on the reactions, right? If there is a full sanctions against Russia, then the impact will be huge, because immediately you talk about the flows of oil up to 2.7 million barrels per day flow of oil from flows of oil from Russia to the West may be interrupted, and again natural gas too, and also depending on how Russia will initiate any of the actions. But short of the full sanction, the impact will be partial. What I mean is, physically you have a problem, you have troubles, and letting alone the market sentiment. We do believe that for the on a daily basis, yes, prices will soar above the current levels, which is close to $100 on the daily Brent basis already. Yeah, that will happen, and the question is, and then we'll see what aftermath of the whole action of Russian invading Ukraine.
And then there's also the factor that investors are watching out for in terms of the talks between the US and Iran. What do you believe could emerge on that front, and how do you believe it could change the dynamics for crude oil prices?
For that matter, the US-Iran talk, that has been, has a longer period of time being priced in by the market. Regardless, even at best scenario in terms of supply, it will not affect the market, for the one or 2 months time frame. But after April, it could start delivering the volumes in April, May onward. And without it, of course, that will have a lot of pressure on the second half of the year. Indeed, that's another ongoing factor on both the physical supply of oil, but also the market sentiments. So any extreme outcome, which means a full deal, which is certainly will press down the market, press the market down, the oil prices. But if there's no deal at all, then they'll be sending other signals. But we expect something in between.
Peter, good morning. I'm going to put it as crudely as I can. I'm not attempting to pun over here. With Brent, for example, going past $96 a barrel, we've seen global influential brokerage firms talking about, the triple-digit mark not being very far. My question to you is $100 or the $90 to $100. Do you expect this to be the new normal for the rest of this year? And we're only in February.
That's very, very difficult to answer, because what we've seen over that last 2 months is a 40% price spike from 70 to 96. So, we're just shy of 40%. I don't think there would have been an analyst out there that would have thought that we would have had this velocity over the last 60 days to take us to nearly $100 a barrel. No one had foreseen the global situation and into the level of what we've, in that dramatic move to the upside. Will it be the new trading range? That depends on a couple of factors. As Dr. Wu mentioned, if this turns into a full-scale situation between Russia and Ukraine, and certain situations ramp up with Iran and with US, then we could certainly see above 100 as our flat line, and that's where our average will be. But if things become far more manageable, then I would say you'd be probably back to the $80 range. This is the issue that we face at the moment. It's so difficult as far from a price perspective, but all I'll say is this: it's going to be extremely volatile over the next matter of months.
So volatility will, of course, be the name of the game. So Kang Wu, let me put it in another way then. 16th, tomorrow, Wednesday, let's see if we actually see the incursion turning into an invasion. There's so many different kind of signals that you get from foreign media as well of what America is thinking, what's happening in Ukraine too. If we don't see that invasion, do you think we'll come back to that $70 type mark quite as soon as we went to the $96 mark?
Very good point. In our view, the current pure fundamentals, supply demand fundamentals, probably support something like $75, $75, $80. If we retreat back to fundamentals, we will say that probably we're going below $80. There are some other factors other than the geopolitical risks. There's certainly the impression of the supply interruptions in countries like Libya, Kazakhstan, Ecuador, or even in Russia itself without the Ukraine issue, and Angola. Those are the short term. They are gradually restoring the supply there, but fundamentally they can be a concern. The capacity constraint of OPEC Plus is another factor coming into play during the second half of the year. And we mentioned Iran earlier. Our basic view, when I say in between, we mean that there are some volumes of Iran are likely to come over to the market with some kind of agreement between all parties, particularly between U.S. and Iran, that there will be a freeze of the nuclear program, and that there are some waivers and there are some volumes to be released. So we could be fundamentally we could be back to $75-80 world.
All right, we'll let you go on that note. Appreciate your time, Dr. Kang Wu, as well as Peter. Thanks so much for joining in. Volatility clearly is the name of the game when it comes to crude oil prices, owing to the escalating global tensions. That's really the verdict.